number of failed businesses around Australia almost doubling within a year.
A new study finding cash flow is the top reason entrepreneurs are losing sleep.
As an accountant, I've witnessed business owners get completely tripped up by two tax culprits, income tax and GST. And here's why. We've seen it time and time again. Business owners in the early stages of their entrepreneurial journey tend to put tax obligations on the back burner. After all, they're not generating huge profits yet, so it's easy to think that the taxes can wait. But when the profits do start rolling in and they're hit with income tax and GST bills that they didn't plan for, it can be a real gut punch to their cash flow. In fact, according to the Australian Taxation Office, a staggering 12.5% of small businesses face financial stress due to tax debts. Take, for example, a small tech startup that finally gets its big break. They've been working hard, bootstrapping their way to success, and suddenly they land a massive contract. Their revenue skyrockets, but they haven't been keeping up with their tax obligations. When the tax bill comes due, they're blindsided by the amount they owe, and it takes a significant bite out of their cash flow, forcing them to scramble to make ends meet. It's a harsh reality, but being unprepared for tax obligations can cripple even the most promising businesses. That's why it's crucial to understand the differences between income tax and GST from the get-go and to plan accordingly. Now, the good news, I'm here to help you avoid these pitfalls and set your business up for the long term. Let's break down the differences between income tax and GST so you can better understand what you're dealing with. Income tax is a tax on the profits your business generates, while GST, or goods and services tax, is a tax on the sale of goods and services your business provides. Income tax is calculated based on your net income, which is your total income minus allowable deductions like your operating expenses and depreciation. The ATO sets the income tax rates, which vary depending on your business structure. Sole traders, partnerships, trusts, they all have different rates. Now, on the other hand, GST is a 10% tax that's added to the price of most goods and services. If your business is registered for GST, you'll need to collect this tax from your customers and then pay it to the ATO. But don't worry, you can also claim GST credits on expenses you've paid on business-related purchases. You'll need to register for GST if your business has a turnover of $75,000 or more per year. As for income tax, all businesses are required to pay it regardless of their structure or their turnover. Let me use one of our clients as an example. She runs a small online store that sells handmade jewelry. Her store generates $100,000 in revenue per year. Currently, she operates as a sole trader, so she has to pay income tax on her net profits at her personal marginal tax rate and also register and pay for GST on her sales. So, now that we've got a handle on the basics, let's talk about the tax returns you'll need to submit. Income tax returns and business activity statements, or BAS. Income tax returns are what you submit to the ATO annually to report your business's income, deductions, and tax credits. This helps the ATO determine how much tax you owe or if you're entitled to a refund. Regardless of your business structure, whether you're a sole trader, partnership, company, or a trust, you'll need to lodge an income tax return each financial year. A BAS is a periodic statement that businesses registered for GST must submit to the ATO. Your BAS outlines the GST you've collected and paid, as well as your PAYG withholding and instalments. The frequency of your BAS lodgement can be monthly, quarterly, or annually, depending on your business's reporting preferences and turnover. Most businesses do this quarterly. Now that you're familiar with the ins and outs of income tax and GST, let's talk about managing your tax obligations effectively to avoid any cash flow issues. Number one, plan ahead. One of the best ways to manage your tax obligations is to plan for them. Set aside money regularly to cover your income and your GST liabilities. This way, you won't be caught off guard when it comes time to pay up. Consider opening a second bank account for tax savings so you don't accidentally spend the funds on other business expenses. Number two, stay organized. Keep accurate records of your income, expenses, and GST transactions to make tax time less stressful and give you a clear picture of your business's financial health. Number three, use software and tools. 89% of small businesses are now using digital solutions to manage their tax obligations. Software like Xero, QuickBooks, and MYOB can help you track your income, expenses, and GST transactions in real time, making reporting a breeze. These tools can also help you generate reports, track cash flow, and even forecast your tax liabilities. Number four, monitor cash flow. Cash flow is the lifeblood of any business. Regularly review your cash flow statements to identify any potential issues and make adjustments as needed. And number 5, get professional advice. If you're unsure of your tax obligations or need guidance on managing your business finances, consider consulting a tax professional or financial advisor. They can provide expert advice tailored to your specific situation and help you stay compliant with tax laws. At the end of the day, you've poured your heart and soul into your business, and it's only natural to feel overwhelmed by the tax side of things. But remember, it's not just about meeting your obligations, it's about gaining the financial confidence and control that'll drive your business to new heights. So, take these insights, put them into action, and build a solid foundation for your business to thrive on. If you have any questions, leave them in the comments below and we'll get back to you. My name's Jordan from Grace Based Advisory. Thank you for listening and we'll catch you next time.